Silver crossed $81, and what happened in the hours that followed tells you more about the structure of this market than the price itself. This wasn't a gradual climb, it was a spike with volume behind it, the kind that doesn't happen by accident. The question isn't whether silver went up, the question is who moved first and what they know that hasn't been priced in yet. Three forces converged. Inflation data came in hotter than expected, but that's surface level. What matters is that industrial buyers started competing with investment demand in a market that's already tight. Silver supply hasn't kept pace with solar panel production, EV infrastructure, or grid expansion. Then you had a sudden shift in futures positioning. Large speculators flipped from net short to net long in under 2 weeks. That's not sentiment, that's repositioning ahead of something structural. The rally wasn't driven by retail panic, it was led by institutional flow. You could see it in the ETF inflows, the options activity, the way premiums on physical silver widened faster than spot, and someone with size was buying, and they weren't waiting for confirmation, they were creating the move. That's the difference between a speculative bubble and a supply-driven breakout. Bubbles are built on leverage and narrative, and breakouts are built on scarcity and coordination. Compare this to 2011. Silver hit $49 on margin speculation and then collapsed when CME raised margin requirements 5 times in 2 weeks. That was a liquidity event, not a fundamental one. The rally was fast, the holders were weak, and the system crushed it. This time, the structure is different. Debt levels are higher, central banks are still expanding balance sheets, industrial demand isn't cyclical anymore, it's structural, and the players holding silver now aren't using 50-to-1 leverage. They're holding physical, they're holding long-dated calls, and they're positioned for a longer game. But parabolic moves create their own risks. When an asset goes vertical, it attracts 2 kinds of buyers. Those who understand the thesis, and those who are simply chasing. The second group provides exit liquidity for the first. If you bought silver at $79 because you saw the chart, you're vulnerable. If you bought it at $35 because you understood the fundamentals, you're watching for the next leg, not the next tick. Here's what matters now. If you already own silver, this isn't the time to add on emotion. You don't chase parabolic moves. You protect gains and wait for consolidation. A pullback to 72 or 68 would be healthy. It would flush out weak hands and set up the next structural move. If you don't own silver yet, buying at 81 is a timing risk unless you're prepared to hold through volatility. The safer play is waiting for a retest of support, ideally after a 10 to 15% correction. That's where conviction separates from speculation. The psychology here is predictable. Fear of missing out drives bad decisions. When silver was at $28, no one cared. At 50, people were curious. At 70, they started paying attention. At 81, they went in. That's backwards. The trade was obvious when it was boring. Now it's crowded, and crowded trades don't end well for latecomers. The professionals bought the dip. Retail buys the headline. Now let's talk forward scenarios. Best case, silver consolidates between 75 and 85 for the next 2 weeks, then breaks 90 on continued industrial demand and a weaker dollar. That would confirm this isn't just a speculative spike, it's a regime shift. Worst case, a sharp reversal back to 65 within 7 days, triggered by profit-taking and a temporary easing in inflation expectations. That would trap momentum buyers and reset sentiment. Most realistic, silver pulls back to the low 70s, holds that level for 3 to 4 weeks, then resumes higher. That would be a classic breakout, retest, continuation pattern, and it would give long-term holders the confirmation they need without the emotional whipsaw. Over the next 3 months, the range that matters is 60 to 100. If silver breaks below 60, the thesis is delayed, not broken. If it breaks above 100, it's entering a psychological zone where governments start paying attention. They don't like assets that move that fast outside their control. Watch for regulatory talk, margin hikes, or sudden ETF redemption restrictions. Those are the tools used to cool off markets that threaten narrative control. Here's a decision framework. If you bought silver as part of a long-term inflation hedge and systemic risk play, you hold. This move validates the thesis. You don't exit on price alone, you exit when the fundamentals reverse, and they haven't. If you bought silver recently hoping for a quick gain, you're in dangerous territory. Take profit on half, lock in gains, and reassess. If you're sitting on cash debating entry, don't chase, wait for blood. Wait for a pullback that makes you uncomfortable. And that's when disciplined buyers act. The broader implication is this: silver isn't just reacting to inflation anymore. It's reacting to distrust. Distrust in fiat stability, in central bank credibility, in the ability of governments to manage debt without destroying purchasing power. That distrust doesn't disappear when the price corrects. It compounds, and every time silver spikes, it pulls more people into that realization. The metal becomes a statement, not just a store of value. What's happening now isn't about one rally, it's about recognition. Recognition that the system has structural cracks, that alternatives matter, and that positioning early beats reacting late. Silver at 81 is a signal. It's telling you the market is starting to believe what the data has been saying for years. The question is whether you're positioned for what comes next, or whether you're still trying to catch what already moved. Silver is no longer just a metal, it's a battlefield. And the side that wins is the one that understood the war before the first shot was fired. Silver just crossed $81. And if you don't understand what type of investor you are right now, you're about to make a decision that costs you more than money. This isn't about whether silver is expensive. It's about whether you're positioned correctly for what happens next. Because at new highs, the difference between a strategic entry and a reckless one isn't the asset, it's the intent behind the trade. There are three types of people watching this price right now. The first group has been holding for years. They didn't buy silver because of a chart. They bought it because they understood the structural problems before the market priced them in. For them, $81 isn't a surprise, it's confirmation. Their question isn't whether to sell. It's whether this move is real, or if it's another false breakout designed to shake out weak hands before the actual repricing begins. They've seen rallies collapse before. They know euphoria doesn't mean momentum. They're watching volume, they're watching who's buying, and they're deciding if this is distribution or accumulation. The second group is made up of traders. They don't care about the thesis, they care about the setup. They entered somewhere between $28 and $50, rode the move, and now they're managing risk. They're not emotionally attached. They're asking one question: does the chart support continuation? Or is this where smart money rotates out? For them, $81 is a decision point, not because the number matters, but because new highs always bring in new participants. And new participants change the character of the move. Traders know that when retail floods in at the top, volatility spikes, and volatility kills poorly timed entries. So they're either taking profit into strength or waiting for a pullback to reload. Either way, they have a plan. And the third group just arrived, and they saw the headlines, they heard about the breakout, and now they're trying to decide if they missed it or if this is just the beginning. This is the most dangerous position to be in because urgency replaces strategy. The fear of missing out overrides the discipline of waiting for confirmation, and that's exactly when mistakes happen. Buying at $81 without understanding support levels, without knowing where the exits are, without knowing if this is a blow-off top or a structural shift, turns an opportunity into a trap. The charts are telling a story, but only if you know how to read them. Silver broke resistance at $32, held it, then pushed through $50 without a major pullback. That's not normal. That's not retail. That's coordinated accumulation by participants who don't care about short-term price. They care about position size. But now at $81, momentum indicators are stretched. RSI is deep into overbought territory. Sentiment has shifted from cautious optimism to outright conviction. And that's when you have to ask, is this conviction based on fundamentals that haven't been priced in yet? Or is this the emotional phase where late entrants provide exit liquidity for early holders? Support matters now more than ever. If silver holds above $74 on a pullback, that's a sign of strength. It means the breakout is being defended. It means buyers are still absorbing supply at elevated levels. But if it breaks below $70, that changes the structure. It suggests the rally was driven more by speculation than by a real shift in demand dynamics. And if you entered at $81 without knowing where those levels are, you're not investing, you're gambling. The biggest mistake people make at new highs is confusing price action with validation. Just because an asset is rising doesn't mean the move is sustainable. Just because everyone is talking about it doesn't mean the opportunity is still there. The best entries happen when nobody cares. The worst entries happen when everybody knows. And right now, everybody knows. That doesn't mean the move is over. It means the easy part is over. From here, volatility increases, drawdowns get sharper, and only the people who understand their strategy survive the next phase. If you're a long-term holder, your move isn't complicated. You're not chasing, you're either adding on pullbacks or holding your position. You understand that silver isn't just a trade. It's a hedge against the structural instability that central banks can't fix. And governments won't acknowledge. You're not selling into a 20% correction because you know the thesis hasn't changed. You're using corrections to acquire more at better prices. Your edge is patience. Your advantage is that you're not operating on the same timeline as the market. If you're a trader, your job is risk management. You don't marry the position. You don't care if silver goes to $100 or crashes to $50. You care about probability, edge, and execution. That means you're taking profit into strength, not hoping for more. It means you're using stop losses, not narratives, to protect your capital, and it means you're waiting for a pullback before re-entering, because chasing new highs without confirmation is how traders blow up accounts. Dollar cost averaging works for investors, it doesn't work for traders. Traders need clean entries, tight stops, and a plan for both directions. If you're new, your only smart move right now is to wait. Not because silver can't go higher, but because entering at $81 without a plan, without knowing your risk tolerance, without understanding where the exits are, is how you turn a winning trade into a loss. The opportunity didn't disappear, it just shifted. Now, instead of chasing the breakout, you wait for the pullback, you watch how the market reacts at support, you let the late buyers get shaken out, and then when the chart confirms strength and sentiment cools, you enter with a plan. That's how you survive this phase, and that's how you avoid becoming exit liquidity. For people who bought at $30, silver at $81 is not a yes or no question. It's a question of position, timing, and intent. If you know why you're here, you know what to do. If you don't, the market will teach you, and the tuition is expensive. Silver just crossed $81. And if you understand what that number represents in the current structure, you know, this isn't about a rally. This is about positioning ahead of something larger. The move wasn't gradual. It wasn't driven by retail sentiment or technical breakouts. It came from coordinated demand at the institutional level, timed with central bank activity that hasn't been this aggressive since the currency instability of the early 70s, when major players move into physical assets. Simultaneously, they're not chasing returns, they're exiting exposure. Wall Street isn't discussing this publicly because the narrative doesn't serve their current allocations. What's being called a commodities surge is actually a structural shift in how large capital views paper versus tangible assets. Demand for silver spiked not because of speculation, but because supply agreements are tightening. At the same time, industrial consumption is accelerating beyond forecast. Central banks in Asia and the Middle East have been accumulating metals quietly for 18 months. That doesn't happen without information. They're not betting on price. They're hedging against currency dilution that has already been set in motion through coordinated monetary policy. Fear isn't the driver here. Preparation is. The real catalyst isn't investor psychology. It's the hard numbers behind industrial demand that can't be met under current production capacity. Electric vehicle manufacturers alone are projected to consume more silver in the next 4 years than the entire photography industry used in 2 decades. Solar panel production has tripled since 2020, and each megawatt requires approximately 200 ounces. These aren't trends. These are locked-in supply commitments with no viable substitute material at scale. Add to that the semiconductor expansion across 3 continents, and you're looking at industrial demand that wasn't priced into the market even 6 months ago. And this isn't about speculation. It's about the gap between what's needed and what's available. At the same time, currency devaluation isn't a future risk. It's a present condition being masked by official inflation metrics that exclude the assets people actually need to survive and operate. When the dollar loses 4% of its purchasing power in a single quarter, while official reports claim 2% annually, the gap becomes a signal. Silver, unlike gold, carries both monetary and industrial value, which makes it uniquely positioned when confidence in fiat systems erodes and manufacturing demand simultaneously spikes. The supply shortage isn't theoretical. Primary mines are operating at near capacity, and secondary sources are drying up as scrap flows decline. You can't print more silver. You can't policy your way out of a physical deficit. $81 is a technical threshold, but it's also a psychological level that triggers institutional repositioning. If silver holds above this range for more than 2 weeks, the short positions built up over the last 18 months become unsustainable, and a short squeeze in the silver market isn't like equities. It involves physical delivery obligations that can't be rolled indefinitely. The concentration of shorts among a small number of players makes this especially unstable. When one major holder exits, the others have to move simultaneously or face margin calls that spiral. Retail investors are starting to notice, and while their capital isn't large enough to move the market alone, their demand for physical product removes supply from the system, which tightens the pressure on paper contracts. Large institutions aren't waiting to see what happens. They're repositioning now, which is why premiums on physical silver have decoupled from spot price by margins we haven't seen since the supply disruptions of 2020. The next move depends on whether this level holds or breaks. If 81 becomes support, the path to 100 isn't speculative, it's mechanical. Once physical shortages force contract settlements in cash instead of delivery, confidence in paper silver collapses, and the divergence between physical and futures pricing accelerates. That's when the broader market realizes this isn't a commodity trade, it's a systemic issue. The second scenario is a sharp pullback to 65 if a major holder dumps inventory to defend short exposure, or if industrial demand softens due to a synchronized slowdown. The signal to watch isn't price alone, it's the spread between physical premiums and futures contracts. If that spread widens above historical norms while price climbs, the squeeze is already underway. If premiums compress while price rises, it's speculative froth that won't hold. What matters now is positioning, not prediction. If you're entering this market, the strategy isn't to chase the move. It's to accumulate physical exposure on any pullback below 75 while premiums are still manageable and scale in with limit orders rather than market buys. So avoid leveraged products. This isn't a momentum trade, it's a structural play that will either validate over quarters or collapse in weeks. Your exit isn't based on a price target, it's based on the breakdown of the physical paper relationship, which you'll see in delivery failures, widening premiums, or sudden ETF liquidations. If you're already holding, the decision isn't whether to sell at 100, it's whether the system can sustain current demand without a reset in how metals are priced and delivered. The next phase will separate those who understood what was happening from those who reacted to what already occurred. This isn't about being early, it's about recognizing when the infrastructure behind pricing mechanisms starts to fracture and positioning accordingly before that becomes the consensus view.